Hello and welcome. My name is Feargal Deery and I'm a fixed income portfolio manager here at Fineco Asset Management. Today I would like to talk about our latest fund offering, the US Dollar Bond Fund. This Article 8 fund is an actively managed fund against a benchmark comprised of US Treasury bonds. As a result, the fund by construction is substantially or fully invested in US Treasury bonds with off-benchmark holdings chosen by taking credit quality, yield and ESG characteristics into account. The average annual return of the US Treasury bond market over the past 50 years is 6%, but last year the Treasury bond market suffered, falling over 10% in 2022 as the Fed started to increase interest rates to restrain inflation and bring it back below 2%. This was the worst annual performance of the US Treasury bond market in over 50 years. Arguably, we are coming close to the end of the rate hiking cycle in the US. The Fed are currently guiding financial markets that there are 2 hikes away from the end of the current interest rate hiking cycle. After analysing similar periods in the past, if historical patterns repeat, investing in the Treasury bond market as the Fed come to the end of a hiking cycle should provide investors with above average returns over the medium term. To illustrate how the US Treasury bond market performed from just before the end of a rate hiking cycle, we can look to 4 similar periods over the past 30 years. Between 1994 and 1995, Alan Greenspan raised rates 3% until halting in early 1995. Investing in the US Treasury bond market at this point returned around 19% over the following year. Between 1999 and 2000, following a rate hiking cycle of 175 basis points from the Fed, investing in the US Treasury bond market at this point returned approximately 14% over the following year. In 2006, Ben Bernanke finished a rate hiking cycle that Greenspan had initiated in 2004. Rates rose 425 basis points over this period, and from the end of this hiking cycle and over the next 18 months, the US Treasury bond market returned 13%. Holding US Treasury bonds for an additional 12 months resulted in a 30% return as the world grappled with the global financial crisis. Finally, in her last meeting as Fed Chair in December 2017, Janet Yellen began the most recent rate hiking cycle. Jay Powell continued to raise rates when he replaced Yellen as chair, stopping exactly 1 year later in December 2018 and 125 basis points higher in rates. US Treasury bonds gained over 10% during the subsequent 12 months. This rate hiking cycle has seen Jay Powell increase interest rates by 500 basis points up until this point, with the Fed guiding markets to expect an additional 50 basis points this year. This increase in interest rates dwarfs the last 4 interest rate hiking cycles. But it is this increase in interest rates which provides the US Dollar Bond Fund with an attractive current running yield of 4.4%. This fund is an ideal vehicle for investors who believe we are close to the end of the interest rate hiking cycle from the Fed and want a clean way to express the view that US Treasuries are due a rebound. A final word on share classes. The base currency of the fund is in US dollars, and we are offering investors the choice between 2 share classes. The Euro unhedged share class is suitable for investors with a positive view on US Treasury bonds and the US dollar versus the euro. The second share class is a Euro hedged share class, and this is suitable for investors with a positive view on the US Treasury bond market but with no view on the Euro-dollar exchange rate. The cost of hedging out the Euro-dollar exchange rate risk is currently priced at about 1% on an annual basis, meaning if the US Dollar Bond Fund returns 11%, the Euro hedged share class should return 10%. Thanks a lot for your time and see you for the next video pill.